welcome back. Tactical Futures, session number 9. Now we're going to really talk about contract rollover and expiration. And this is really a very important segment because a misunderstanding of expirations and contract rollovers can be one of the biggest and most painful expenses that you will have as a trader. If you don't understand expiration and contract rollover and you hold your positions through rollover, you can face very adverse reactions based upon the price which happens on a rollover. So this is a super, super important element here in session number 9. So we've talked about what contracts are listed, but now let's talk a little bit about the settlement, right? Whether they're deliverable or if they're cash settled. Now, this is a picture of crude oil, and crude oil is a physically deliverable contract, meaning if you hold that contract to expiration, you will get those products delivered to your driveway. And so think about it like this. If you have a physically deliverable contract, you're going to have barrels of oil that show up on your driveway. Or if it's corn, it's going to be corn that shows up. Or if it's oil, it's going to be, or if it's silver, there may be bars of silver. So physically deliverable futures contracts, upon expiration, you either receive the product or you have to provide the product. Now, if you have to provide the product, that means that you have to go out and buy it on the open market and provide the product. And that can be very detrimental to investors. Now, the other types of settlement are financially settled, right? It's just the difference between what the contract was worth when you got it and what it's worth today. So you really want to know whether they're physically or financially settled. But in reality, the settlement is super important, but more important than the settlement is the expiration. So reading this one, we can see that the trading terminates on the 3rd business day prior to the 25th calendar day of the month to the contract month. If the 25th calendar day is not a business day, trading terminates 4 business days prior to the 25th calendar day of the month prior to the contract month. So this tells you what day the crude oil futures contract will expire. Now, each contract is going to have an expiration date, and you're not going to want to hold the product to expiration. Now, here's the interesting thing. Let's say that it's crude oil, and you're going to be required, we talked about contract size earlier, you're going to be required to buy 1,000 barrels of oil or to deliver 1,000 barrels of oil. Well, what if you can't fulfill your obligation, right? What if you, the investor, can't fulfill your obligation? Well, in that case, the broker has to fulfill your obligation. Well, what if the broker can't fulfill their obligation? Well, in that case, the exchange is required to fulfill the obligation. The point being is that the obligation will get fulfilled. And so what happens in most broker dealers is that they have automatic triggers in place to roll over your contract so that you don't hold anything until expiration. And so when we're looking at expiration, each futures contract is going to have an expiration date that's unique to that contract. And each expiration month has a corresponding letter to identify the proper month. So here is our contract month guide, January through December. And it starts with F and goes all the way to Z. Now, not every letter is listed. You can see that. But if there's quarterly expirations, you will just have HMUZ contracts. If it's monthly expirations, there's FGHJKM, NQU, VXZ. So when we look at a symbol is made up of 3 parts. We've already talked about the ticker symbol, and the ticker symbol is the unique product code that identifies the product on the exchange. But it also includes the expiration month and the expiration year. So for example, CLU21 would be the crude oil September 21 contract, right? We know that this is a crude oil contract that expires in the month of September in the year 2021. If that were CLZ21, based upon our prior chart, we would know that it's a December contract. And so when I look at the calendar will show me what months are available in each product. So for example, if I'm looking at the specifications, this gives me all of my contract specs for, in this case, gold. But if I go to the calendar, you can see GCQ 21, GCU 21, GCV 21. So it gives you the specific product code. Now, why is the year important? Well, because here I have GCG 23 for February of 2023. So the year is also a very important element when looking at your contract month. So looking at this CLU 21, we can see that this is where this is listed. CLU 21, this is trading the September futures contract. Now, the thing to remember about this is that this is what's known as a contract specific symbol. A contract specific symbol tells me my exact contract that I'm trading, and it charts from the inception of that particular contract. So, right from when that contract began. So, let's take a look, for example, at the CLZ 21. And if I look at CLZ 21, let me go to a 10-year daily chart. I will do a 20-year daily chart. And if I go all the way back, you can see this contract has been traded all the way back since 2013. Now, you see that there was not very many trades happening in 2013, but the contract did indeed have trades all the way back to 2013. Well, what if I do the ESZ21? Well, this one only goes back to last year, right? So this one only goes back to last year, doesn't go back as far. So because this is what's called a contract specific contract. It's showing me that exact contract in which I'm looking at, right? If I do the /ES, however, I'm going to see contracts all the way back. Well, that's because that's known as a continuous contract symbol. Now, a continuous contract symbol is used to build a continuous chart. And so what it does is it shows a chart that never expires. Now, when you look at these contracts, they can be either what are called adjusted or unadjusted. Adjusted means that they are adjusted for rollover dates in order to kind of blend the months that come together. Unadjusted means that it's just going to take one contract when it ends and put another contract right next to it. So let me explain how that works. So here, for example, is CLU 21, which is our contract specific for the September 2021 crude oil contract. Here is the /CL, which shows me all of the months. And you can see these dashed line here, CLK, CLJ, CLH, CLG, CLF. These dashed lines up here at the top represent the expirations for each of my given months. So how is this continuous contract created? Well, let's look at it, because here's a continuous contract on the Japanese yen, the 6J. And what you can see right here, this is the 6JH21. This is what's called contract rollover. And on contract rollover, you can see that we have a gap in price. Now, one of the things that I want to focus on when I'm looking at this 6J is not just the contract itself, but we're also going to pay some specific attention to our scale over here on the right, because that's going to be a very telling element for what we're looking at. So when I'm identifying where these areas might be, I'm going to have to know what is the front month contract, which is the same as the near month, and what is the back month, which is the same as the forward month. So the near month contract is the one with the most volume. Okay, it's the one with the most volume in the cycle being traded. The back month is the futures contract that preceding the front month. So it's just happened, right? Contract rollover is when traders shift from the front month contract to the back month contract, which then becomes the new front month contract, right? So we're always going to trade the one with the most volume. We talked about that earlier when we looked at the volume and open interest of each of these contracts. So here is our 6J Z20. So if we look at our 6J Z20, what I want you to pay particular attention to is that we're looking at a Z contract, which means that it is December. And as I look at this, I've got my scale over here on the right. Price is at 0.009618. That's the current price of the 6J Z20. But what I really want to pay attention to is this area right here, because this circle represents my contract rollover. Now, here is the 6JH21. Same area contract rollover. If I go back to the Z contract and the H contract, those two areas look the same. However, when I combine them, so here's the Z contract, and we can see over here my scale over on the far right. Well, if I take the 6J20, that's the contract we have here, and I add to that the 6H21. Now, here's what I want you to notice specifically, is that I very intentionally on this chart overlaid 967 with 967. I very intentionally overlaid 963 with 963 so that we're comparing apples to apples. Now, when I do that, you notice that a gap appears. No gap appeared when looking at the contract by itself, but a gap does appear when looking at the continuous contract, because those two contracts together is what creates the 6J contract. So let me go back and look at them without each other. So notice, no gap on the Z contract. No gap on the H contract. But when I put them together, there is a gap on the continuous contract. Now, that's why these are put together, because this is when volume significantly shifts. Volume is going to dictate when switching from the front to the back month. When the back month contract exceeds the volume of the near-term trading contract, you begin a new contract. Okay? Changes in the symbol are caused by the new expiration. And then the changes in value are what cause rollover gaps. So just because the CL is different one day than the next, the CL, which is the continuous contract, is going to be different. Now, the exchange is not going to recognize a continuous contract. That's done by the broker-dealer, and different broker-dealers have different nomenclature for creating the continuous contract. This particular broker-dealer just uses slash ticker symbol, right? So if I want the slash 6M, that's the Mexican peso futures, right? But if I do the slash 6MZ21, that's the December 2021 contract, right? If I do the 6MU21, that would be the September contract. But slash 6M would be all of the contracts stitched together. So this topic can get a little bit confusing, and this is why it's going to be very important to go to the CME group and understand how to read the calendar on each individual contract that you trade, and also to ask a lot of questions in the live trade room. This can be a very complicated topic that a lot of people get lost on, and the best way to do it is to be trading during the rollover periods to understand what's the contract that I should be using. And also pay attention to your broker's warning signals. Your brokers typically will send out some sort of an alert when it's a contract rollover so that you don't get stuck holding the bag. And really, they don't want you holding the bag, because if you don't have the money, they're the ones who have to come up with it. So there's automatic contract rollovers for most accounts. Sometimes the brokers will just completely close you out, but you certainly want to know the rules around contract rollover. So, like everything else, if you have any questions, send us an email, support@tradersarmy.com. We're about to get rolling into the next session where we start to talk about what are the items that we trade and really spend some time looking at our individual asset classes.